In this pod, we're going to go over the fundamental financial key terms regarding costs, revenue, and profits.
The main aim of most businesses is to make a profit. Profit is basically any additional money left after expenses. But even if a business's focus isn't purely on profit, it has to earn enough money to cover its costs. Otherwise, it can't survive. So, it's important to understand the main key terms.
When a business earns money, this is called revenue. If you own a coffee stall in a shopping centre and you sell one coffee for £2.50, then you earn £2.50. If you sell two coffees, you earn £5. It's £2.50 by 2, which gives £5. So revenue is the selling price multiplied by the number of items you sell.
Does this mean the coffee shop ends up with £5? Well, no. They have lots of things they have to spend money on. There are two main types of costs. These are fixed and variable costs. Fixed costs are costs that don't change no matter how many things you sell, and variable costs do change based on the number sold. Let's look at an example with the coffee shop. It has costs like the coffee beans and renting the store. It doesn't matter if it sells one coffee or 1,000,000 coffees, the rent for the shop won't change. But it will need to buy more coffee beans if it sells more coffee. So, coffee beans are a cost that changes. They're a variable cost. The rent doesn't change, so this is a fixed cost. A good way to remember this by thinking variable varies, so it changes. Fixed is always stuck, or fixed in one place, so will stay the same.
Before we can work out profit, we need to work out total costs. This really simply is the variable costs added to the fixed costs. So revenue is the money the business gets, and costs are monies that the business spends. To work out profit, you simply take your total revenue and subtract your total costs. But if your costs are higher than your revenue, you'll end up with a loss instead of a profit.
You can then take this further and calculate profitability ratios. This is a way of showing how well a company is generating profit and is excellent for comparing performance. This can be done to compare different businesses or one business over different years. To calculate the ratios, there are two types of profit you need to know about: gross profit and net profit.
Gross profit is profit just based on selling products. It's your revenue minus the cost of sales, which means the cost of the stock. Net profit is the final profit, which is revenue minus all your costs. Let's look at an example. If your coffee shop sells 100 coffees at £2.50, the total revenue is £2.50 times 100, which is £250. You spend 50p per coffee on the ingredients and £70 renting the stall. This means the cost of sales is 50p multiplied by 100, so £50. You spent £50 buying the ingredients or stock you needed to sell those 100 coffees. In this example, the gross profit would be £250 minus £50, which would be £200. The net profit takes off all costs, so you'd also take away the rent of £70 and end up with £130 net profit.
To calculate the ratios, you need to know the correct formulas. The gross profit margin is gross profit divided by revenue times 100, and the net profit margin is net profit divided by revenue times 100. Looking at the previous example, the gross profit margin would be 200 divided by 250 times 100, which would be 80%. The net profit margin would be 130 divided by 250 times 100, which would be 52%.
The final calculation is average rate of return. This looks at the average money a business gets back from an investment. You simply take an average yearly profit, divide it by the cost of the investment, and multiply by 100 to put it in a percentage. As an example, if your coffee shop expects to make profits of £1 million in the first 5 years of opening and cost £300,000 to start up, you'd have an average rate of return of 67%.
This is because your £1 million is divided by the 5 years to give an average yearly profit. This gives average annual profit of £200,000. Take the £200,000 and divide it by the cost of investment, which was £300,000. Multiply the answer by 100 to put it in a percentage, and it gives a result of 67%. Understanding profit is a fundamental concept of business, so make sure you revise and know the formulas.